Full Spread Master Series Effective Leverage. During this brief video, we're going to take a look at what we call effective leverage. Now, you may not be familiar with those two terms put together. However, if you've traded any type of margined product, such as a currency contract or a futures contract, you'll probably understand leverage. What we're going to do is take a look at a scenario of trading the underlying market and then another scenario very similar in trading a bull spread and see how they compare from a margin and collateral standpoint. So as we understand from a bull spread, we should know by now that a price range makes up a bull spread. It has a floor and a ceiling. Price can't trade lower than the floor or over the ceiling. All contracts are fully collateralized. Basically what that means is the collateral we as traders put up is equal to our maximum risk on the trade, so it's clearly defined up front. The buyer's collateral is the difference between the buy price and the floor. The seller's collateral is simply the difference between the sell price and the ceiling. So let's take a look. In this case, we're going to take a look at the pound-dollar spot market. And what we're going to do, we have a chart here of the underlying. Using some simple technical analysis there, perhaps in this example, our bias is we think the market is going to drop. We want to go short. It's currently trading about 156.85, so we decide to sell one contract. Before we place the buy or sell, though, because we're trading the underlying in a leveraged environment, we'll probably want to use a stop in order to control our risk as well as possible. In this scenario, we'll say that we put our stop right around 157.50 or 65 pips away. So we've got to sell at 156.85, stop at 157.50, so our risk is $650. Now, that's hoping that we don't get slipped or we have a volatile market move, in which case our stop may get slipped over or gapped over on a big move. Our margin required in this case at 50 to 1, which is fairly standard to what we see in the currency markets these days, 50 to 1 would be over $3,000, $3,138. And this is at $10 per pip. It's one standard contract. And as we can see, because it is the underlying market, we do have to use a stop to protect ourselves. And as I'm sure many of you are aware if you've traded for very long at all, in some cases we can get stopped out only to see the market move in our favor. Now, even if the market had just run directly in our favor and not stopped us out, the fact remains that in order to place this trade at 50 to 1, we'd have to put up over $3,000 in margin and have about $650 risk. Perhaps we put our stop closer or farther away, thus determine our risk. But our margin is unchanged. Additionally, because this is a margined or leveraged market, if our stop gets skipped or there's a big move, we could stand the risk of getting a margin call and or actually losing more than we had to start with in our account. So let's take a look at a bull spread using the same underlying market conditions. In this case, we're going to take a look at an 8-hour bull spread, range 154.50 to 157.00. I chose this one because we have the underlying market trading very close to that ceiling of 157.00. In this case, we're going to use that for risk control. So here we have our spread ceiling, 157.00. The floor is 250 pips lower, all the way down at 154.50. We have our 8-hour time frame represented there by the blue lines. In this case, on the bull spread, we'd want to sell 10 contracts if we're doing equivalent. So if we sell 10 Nadex bull spread pound-dollar contracts, that would be $10 per pip, so the equivalent of the underlying. In this case, because we're trading short very close to the ceiling, we're probably giving up a little bit of edge to the market, a little bit of optionality is priced in there. So rather than selling at the 156.85, we might be selling around 156.65. In this case, we'd have 35 points or pips maximum risk. As we know, our risk, $350, is equal to our collateral that we put up. That's the most we can lose. So rather than in a margined environment where we could actually lose more than we initially put up or even more than we have in our account, this is our clearly defined risk before we place that trade. Additionally, as the market moves, we're not worried about being stopped out. If the market shot up to 160, it wouldn't matter. Our maximum loss on this trade was $350, and that was our collateral. Additionally, in this scenario, because we didn't have to worry about a stop, we can see that the market had time to move back in our favor. It's no guarantee that would happen in the future for sure, but one of the most important aspects of trading, risk control, was known and clearly defined up front, and that was the absolute maximum we could lose on that trade. So if we look at just a quick comparison, the underlying spot, one standard contract, value of $10 per pip. In this scenario, the risk was $650, margin of over $3,000, versus the Nadex pound-dollar bull spread, still valued 10 contracts, so $10 per pip. So we were able to do a same per pip value, actually cut our risk not quite in half, and instead of margining over $3,000, we only had $350 in collateral. Now again, this is dependent on where we buy or sell within that range, but this is just an example of how we can use the effective leverage of a bull spread and still limit our risk. If you have any questions or would like additional information, more can be found at www.nadex.com. Give us a call at 877-77-NADEX. You can also email customer service@nadex.com.